Alright, Chapter 2, Part 2. Again, this slide, slide 13 on your lecture slides, is probably going to be one of the most important for you. Again, it starts with the basic accounting equation, and then the expanded equation below here, and then it tells you whether to debit or credit depending on you're either increasing or decreasing that account. And you can see that a debit doesn't always mean positive, because here it is a negative. And it'll change again depending on what type of account. Here's your challenge. You got to memorize this, because this is not going to go away. And while you'll do your homework, flipping back to this, you won't have this available in real life, and you do need to know this. It will get easier over time and practice, specifically by doing your homework. It will become second nature, but at first it is quite a challenge, because you have got to remember you have to identify not only what type of account, but whether you're debiting or crediting for that account. So you can see this has gotten far more complex than just your basic accounting equation. You have to memorize this whole thing. I do have a cheat note that I think will simplify this process that I will try to get to you by this weekend. But at first, try to learn it from at least the academic method that is presented here in the book. So let's follow this through. Again, we have double entry accounting. So here we have a basic T account. Here's your T, and then here's your account title. And here we're just using cash. Now you'll notice that there are entries both on the debit side as well as the credit side. Yes, you are increasing cash here, but you're using cash maybe to purchase things or pay your bills. And then at the end of that period, maybe this is at the end of a month, they'll draw a line and they'll tally up what's the remaining balance. They'll add this column and then this column, subtract it out, and you'll have a remaining balance. And you notice this remaining balance is on the debit side, hence its normal balance. If this was equal to the amount of cash, you'd have no balance. But you will rarely ever carry a negative balance over here, because you can't have less than zero cash. So hence this is a demonstration of the normal balance. Journaling and posting. So here's your four-step process. First, you get your variety of source documents to identify what transactions is happening. And you notice it could be from bills, receipts, bank statements. And then you analyze them. And what we mean by analyzing is you're analyzing, am I affecting an asset account, a liability, or equity account? Because once you've identified it, you now need to record it. And this is what you put in the general journal, or what I call the book of entry. You start with the date, the debit credit of the name of the account, and then how much you're debiting and crediting. And then from there you can transfer these balances into your ledger's account that will keep track of the various accounts. So let's follow this through. A couple things here to be aware of. There are a couple components of a journal entry. The first is the date. You always enter in your general journal by date in chronological order. Notice the name of the two accounts. Here we're depositing $30,000, and hence a debit since we're increasing the cash, and then we're crediting the equity account from the owner. Now there's four components to this journal entry: the date, the name of the account, the debit or credit, and the explanation. Notice that this account is indented here. That's to match the credit side. So whatever credit accounts are being credited, you need to indent. And the ones that are being debited, you keep to the left margin. This indentation makes it much easier to read and see, and you can tell what is going on. And then a brief explanation of the note, of the transaction that transpired. And you'll see this go again. You notice cash was on the left-hand side because it was debited. Yet in this entry here, cash was indented, hence credited here. So don't always think cash is always going to be the left-hand side. It depends if you're debiting or crediting. and you do need to have these indented. Again, T accounts are useful for illustrations, but we actually do not draw them out. We tend to let the computer do this, and usually how we track it is we'll just have a multi-layered account like an Excel spreadsheet, and then we'll keep the debit, credit, and then the remaining balance. You notice this remaining balance, we don't mark it as debit or credit because we know that it'll always be in the normal balance, whatever that type of account is. I'm not going to keep track of this in this beginning class at this point in time. This is usually associated by the account number, which is this account. This is what it's tracking here. Posting your journal entries. So once you've journalized, so here you put this into your general journal, and we have a transaction here. Cash being contributed to the account. Again, don't use these account numbers. I'm not worried about it at this point in time. This is more for a computerized system. And then we have to post these amounts into the general ledger account. And so the general ledger is one for cash, and you notice we're debiting the 30,000, hence the balance of 30,000. And then we're taking this credit and we're putting it into the C. Taylor's capital account, 30,000, hence its balance. So you first enter it in the general journal, and then you post it into the ledger account. Double entry accounting is useful for processing transactions, and each transaction follows these 4 steps that we just followed through. You get your source documents, you analyze which accounts you're going to do based on the accounting equation, you post them in the general journal, and then you transfer these to the T accounts or to the ledger accounts. And we can follow these. I think this is easier to read than to listen to in a video in your lecture slides, but we're just going to go through a variety of accounts, and they're just going to be journaling them and then posting them into the ledger accounts. If an individual is asset, so we're going to do some analysis here. So if an individual's asset is increased, there must be a corresponding, and you have 3 choices, a decrease in another asset. An example would be maybe you buy a piece of equipment. So if you increased your equipment, but you're also decreasing cash if you pay for it in cash. So it could be an increase in one asset, a decrease in another asset of equal amount. The other possibility is you increased a liability account. Maybe you bought some equipment again, but this time it was on credit. So now you have a debit credit, but because it's an increase of a liability. Or maybe you have an increase of, let's say, of the stockholders' equity. Again, an example would be the first example. We deposited cash, hence we debit the cash account, but then we increase the stockholders' equity. It will always follow that basic accounting equation. And here we have a variety of transactions that are going through to analyze this. I think this will be easier read than listened to. But you can see we're using cash here to buy equipment, and then we're posting it in the equipment account and the cash account, and so forth. Same with on credit, we're increasing our accounts payable, and now we put that into accounts payable, and we've increased our supplies. You know, always following that debit credit process. And again, we'll follow through a variety of transactions. And then you get to an end of some accounting period, typically the month, the quarter, or the year. And now we're going to create a trial balance. And where you get this trial balance from is you add up all your ledger accounts from various accounts, and you total them all up. And you put all your assets on the debit side, and then you put your accounts payable, your liabilities and equity on the credit side, minus the withdrawals, and then you have your revenue and your expenses, and then you total up this amount. If they are not in balance, you have a mistake, and you need to go find it and correct it. And it's not uncommon to have mistakes. You can, and from the trial balance, we can create financial statements, but you cannot create a financial statement until you have this trial balance actually balanced, hence the name. So again, we transfer everything from the account title from your ledger accounts, and we compute the total debit balance, and we verify that it's true. Unfortunately, it's not uncommon to have errors. And here are the 6 steps to go maybe help verify to find your errors. And for instance, there could be a posting error. You might record in the general journal $3,400 in sales, but then you record it as 34.00, only as $34. So there could be a variety of errors you might have posted. Maybe you posted once as a debit, once as a credit. You got to go back and find it. Again, this can be challenging in real life. Once you have a trial balance that does in fact balance, you can now prepare your individual financial statements. And those 4 major statements are going to be your income statement, a statement of owner's equity, a statement of cash flow, and then you will end, after completing these 3, with a final balance sheet. And that balance sheet then becomes the new beginning balance sheet for the next period. So it becomes circular in motion. Here's an example of an income statement. Notice the components. First, the name of the company, what statement we're looking at, and here's for what period of time. And this is for the month of December. And here we're listing all the revenues. And you notice you might have a variety of revenue streams, which you might break out, maybe by product line, or maybe like your Ford Motor Company, maybe by Europe, South America, Asia, North American sales. There's different ways that companies can track that. Then they list their expenses, and then they subtract the total expenses from the total revenues to get that net income. This number then becomes important, because then we transfer that net income to the statement of owner's equity. Here's your income statement. Now we have this owner's equity account, and we invested $30,000, but now we have to add that net income for that period of time to add to the equity account. And then from there we can complete the balance sheet, and you'll notice now you have all your assets listed, all your liabilities, and now you've increased your capital account, which began at $30,000, but because of the net income minus the withdrawals, you have now this new balance, which becomes your new starting point. Some key issues when just from tricks of the trade: dollar signs are not used in the journals or general ledgers. They do appear in the financial statements because external stakeholders will be looking at this. Usually these internal documents are just for internal use, and it's not necessary. We do use commas. Sometimes they're optional, and a lot of times companies will round either the thousands or the millions, possibly even the billions as we grow here. So rounding but it usually has to be noted at that point in time. That's it for this chapter. Oh, one last point. I'm going to get to this. We're going to begin to introduce a variety of ratios. Ratios is what chapter 17 is about for financial analysis, but as we go through each section, we're going to introduce at least a few ratios, starting with the debt ratio. And the debt ratio is just total liabilities over total assets. And this just evaluates the level of debt. The more debt a company uses, the more risk there is. Now, hopefully you understand that your liabilities will always be smaller than your assets, because once your liabilities get greater than your assets, technically you're in a bankrupt situation there. So these are used a lot by the banking industry, and as well as other creditors and your vendors and so forth. And we're going to be, again, introducing a variety of ratios. Another ratio that's comparable to this is total debt over total equity. Again, the debt to equity ratio. So again, we'll be introducing a variety of ratios as we go through each chapter. This concludes chapter 2. Again, I will hope to get you the accounting cheat note later this week. Thank you.